Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. In the next 20-25 minutes, we'll talk about 2 or 3 key aspects around mutual funds. This time around, we will talk about how to identify what are the right kind of funds for you. So that's the academic part of the show. Then we'll talk about the spate of NFOs that are coming out and what within that universe may or may not look good um, as a generalized principle, if you will. And of course, remember that things might be more suitable for you or less suitable for you, depending on what kind of investor you are or you may be. And then, of course, we will also talk about the thematic funds, a bunch of them out there too. And a lot of people are talking about how it's going to be a very bottom-up market, very theme-specific market. So are there some thematic funds that might actually give you a better bang for the buck than a diversified equity fund? Needless to say, the risks in a thematic fund are always higher. Our guest today, Prableen Bajpai, founder of FinFix, and Bharat Pareek, Head of Product and Segment Private Wealth Management at ICICI Securities. Both of you, thank you so much for taking the time out and being with us on the show today.
Thanks, Neeraj.
Thanks for having
All right.
us.
No, the pleasure is ours. So, I thought we'll start off with the academic part of the show. And a lot of people talk about how do they identify their own risk appetite and then try and figure out what kind of funds might be more suitable for them. Now, you can call it an abstract topic, but you can call it at the same time a fairly relevant piece as well. Is there some thought that you have around it? Probably let me start with you, ladies first, always.
Good afternoon, Neeraj. A very tricky one to answer because I think the risk appetite keeps changing with the market conditions. And I think in the times we are currently in, a lot of people are so tempted to start investing and, make the returns that they are seeing already in the markets. But in nutshell, I think what is important is that you identify your goals first. So once you have identified your goals and you have listed them down, I think that gives you the duration, the time horizon that you have on hand and at hand. And I think that enables people to, sort of chart out that, okay, for a specific goal, I have the next 5 years. For, let's say, retirement, I have 15 years. So I think that can broadly then help them decide on the allocation that they want to have, because I think a lot of people don't know themselves and what sort of a risk they would be comfortable with, and that's the ground reality. And at the end of the day, I think the objective is to be able to meet your financial goals. So I think if you have the time horizon correctly sort of measured, then it's much more easier for any investor to decide on the right allocation for themselves.
Okay. Bharat, let me get you in on this conversation. How do you think about it?
So I agree with her. See, the two core of asset allocation and the risk appetite is about the time horizon and the financial goals. And Neeraj, it's and as she rightly mentioned, when markets are actually at down and 5-10% lower, everybody becomes risk averse. And when the markets are flying, everybody want to chase it, and they becomes risk takers. And I think most important part is the way to you define it is that at what risk you can sleep with, not what risk you can take. So it's important to understand how much you can sleep with, and if you don't have that anxiety of that position or that kind of an asset allocation, I think it's the right asset allocation or the risk appetite adjustment. For we at ICICI Securities Private Wealth, we normally tell our clients to do a 3-part portfolio allocation rather than jumping into an asset allocation and just doing the risk appetite calculation, because you will say 60-40 is good, 30-40 is good, then markets will change, your portfolio allocation will change. What we say is, boss, you do some part of your capital which you want to preserve, keep it in your preservation portfolio. There your return post tax should be better than inflation, and you should be happy with that. And hence you should not get any anxiety with that particular portfolio. A large part of your portfolio is your core allocation, which you are trying to generate. Say, your economy is going to grow at 11% CAGR, and you are talking about, say, 10 to 15% CAGR kind of a return. Have a very well diversified, good portfolio which will generate 10 to 15% return. Obviously, it will come with volatility, but you know that, okay, there will be a period of volatility, but it's not going to eat away into my preserved portfolio, and I'm not going to get really anxiety about the loss in my portfolio, and hence you will not make those impulsive decisions and do some correction in the portfolio which in long term may hurt you. And the third part is, if you really have that additional capital, then you do that alpha generation, take those higher risk portfolio, whether you're taking small cap, mid caps, private equity. But idea here is that you have those bucketing done. Make sure that you don't crisscross each other, don't reallocate portfolio just because markets have moved. Just maintain your asset allocation. Just don't move the money around.
Okay. Just a quick follow-up there, Prableen. Let's assume that somebody believes that or identifies with a risk appetite which is lower than what normally would be. So at the times of extreme exuberance, she's not too comfortable being too exuberant. The times of pessimism, she may be more pessimistic than what usually is, and therefore the person identifies with herself or himself as being a lot lower risk appetite than what usually the market might have. What kind of funds would be suitable for somebody like that?
So,
Neeraj,
okay.
Yeah, Prableen,
Yeah,
sorry, the question was for you.
Okay. So, Neeraj, in such a case, I feel that one thing which needs to be understood is that, let's say the investment is being done for a goal, and let's take a 15-year horizon. So if a person is comfortable with, fixed income, okay, fine, you want to save for your child. Let's say you do a, public provident fund, and you're putting that 1,50,000 a year. And 15 years later, you have a corpus of 40 lakh. Is that 40 lakh going to be enough? That's the first question. And so the person has to understand the math that, okay, then you will fall short of probably the goal that you are trying to achieve. And I don't think that changing your risk appetite can be an overnight exercise. It only happens gradually. And so maybe, to start with, you start taking a limited exposure towards equity, because with the same investment with about 11% returns, I think, which is a very standard return that we take for the markets, the person can actually achieve about 65 lakhs. It's a difference of 25 lakhs for the little additional risk you take. So let's go with a balanced approach here. Let's say you take about 60% of fixed income and you take the rest 40% in equity. You still get about 10% returns, which should not be too uncomfortable. Like Bharat mentioned that fine, probably that is something that you can sleep with, and that can be done over a period of time. So if you have the horizon, gradually you can move from one asset class to the other as the comfort develops. And this is what we call the familiarity bias. People are so comfortable with a certain asset class that it really takes a lot of effort for them to break those biases, and I think a lot of hand holding as well. So for them, to begin with, equity is equity. Even if you're giving them multi-asset, even if you're giving them a balanced advantage, there will be dips. So there is no clear-cut solution. They have to understand that if a goal has to be met, what is the requirement? If it can be achieved with a total fixed income portfolio, well and good. If not, then those additional steps have to be taken to move into equity.
Got it. And I'll flip the question on its head, Bharat, to you. Here's a lady or a guy who is actually very exuberant, willing to take the risk, and let's assume has the appetite to ride the dips as well. What kind of funds would be more suitable?
Whatever it is, right? If it's a high risk taking guy, and I'm sure all of us believe that we are a high risk taking guys, but when those things comes may not work. I normally when we interact and we see this kind of clients, we normally prefer a diversified portfolio with a higher tinge of small cap, mid caps. The strategy in terms of the fund manager which we select for a client like these is actually where the changes happens. They will see more aggressive fund manager in their portfolio, which will be able to provide them that higher alpha and also provide a higher beta to their portfolio. But at the same time, will prefer to have a risk mitigant to them. So every portfolio investor will have a micro risk, a macro risk, and a fund manager risk. We will diversify these three risks, being into equity only. We'll try to see that they are growth oriented portfolios rather than a value oriented portfolios, but they are not growth at any price kind of a portfolio. So we will do a more diversification in those portfolio construction also, but we'll try to make sure that it's just because he is ready to take a risk, it doesn't just end up taking one or two funds with a very highly concentrated portfolio and really create a too much alpha, too much standard deviation, or what we call too much of volatility in the portfolio. A diversified portfolio, but maybe a growth orientation and a little bit more of a small and mid caps.
Well, viewers, I've not tried to get into all the kinds of investors that you might be. Just thought we'll take the extremes so you can kind of choose what kind of investor, or you can think about what kind of investor you are and try and apply some of these principles. But keep in mind some of the guidelines that both Prableen and Bharat mentioned as well. It's very difficult to change the kind of risk appetite that you have in the first place, and therefore the suitability of the funds as well might differ related to the kind of investor you are. Now, work with an assumption that you are a high risk investor and therefore you want to get into thematic funds, because all on across various shows, you hear that certain themes are doing well, certain themes are not. So we thought we'll ask Bharat to try and tell us that from amongst the thematic funds that might be existing in the markets currently, what are the themes that they at ICICI prefer, and what are the kind of funds that they advocate to their clients to take advantage of those themes? Bharat.
Yeah, thanks. So, see, in a portfolio construction, there is a strategic allocation and there is a tactical allocation. Thematics are part of your tactical allocation. It means that maybe 10%, 15%, or 20% of your portfolio is a tactically allocated. And tactical allocation is where we do play theme. So today, when we are looking at one theme which all of us wants to play, is what we call is a election theme, right? Elections are approaching. You want to play the election theme. So you want to make sure that what are kind of the fund which I should go and try to play it. So we've been now holding a PSU fund as a part of our tactical allocation, as a part of a thematic one. So we have an Invesco fund, Invesco PSU fund. This fund is basically playing all the PSUs, manufacturing, your shippings, your defense, and all those things. And guys have taken advantage of it. And just to give you an example, forget about what's happened in 2014. 6 months run up to the election, PSU funds have generated 24% alpha over Nifty. 2019 they've generated 7% alpha over Nifty. So they are risky. You want to play it, you may want to time it, but these are thematic. You have to play it, and then one fine day you say it's all good is good. I made my money, I move away, and you just have to move away. So what we are today doing is that we've been playing this. We've been playing infrastructure as a thematic play. So Tata Infrastructure Fund has been part of our model portfolio for almost 1.5 years now. And this fund has done wonderfully well for our clients. It generated great alpha. Again, being an infrastructure fund, is played on most of those capital goods, all those themes as a part of the story. And India, I think entire China plus one story, manufacturing story is coming up. The infrastructure buildup is coming up. So we picked up a fund which is having more flavor of all those. So 1.5 year, 10% allocation, we have it here. And we are not going away from banking. So we continue to like BFSI. We continue to have as an additional thematic allocation to our portfolio. So today we have around 20% allocation in our broad client portfolio, depend 5% here and there, depend on client to client. But we have this 20% tactical allocation, which is basically played through a PSU, infra, and banking.
I've heard banking, I've heard IT, I've heard manufacturing as well. The election thing is a new one for me, Bharat. So interesting one. But the data is very interesting too, that PSU funds have actually done so well in a 6-month prior run up in each of the last 2 instances. So pretty cool. We'll also try and look up what happened back in 2009, if that is an indication. But Bharat, thanks for this indication. Lovely. Prableen, I know we didn't think of talking about thematic funds with you, but any thoughts here very quickly?
I also love the idea of playing the election theme. I really like that. And I think maybe we can do that even with the US elections coming up next year. Amongst the thematic funds, because I was just looking at the NFOs, Neeraj, and there I did see 2 of the tech funds, being launched, one by Quant and one by HDFC. So I think that is again a space which has done well in the past, pretty beaten down last year. So I think maybe a staggered approach there can be a decent idea. And if you look at the past returns in the sector, actually, so at different periods of time, you look at the SIP returns, and it's not a lump sum investing. You look at the SIP returns on a 2-year, 3-year rolling basis. I think it is given, 90% of the times the returns have been about 15%. So of course, past returns are no indication of what will happen going forward. But I think that theme again looks good. To me, but it has to be before I think the sector turns around, because it's already up a bit, 7-8% this year, and I think we're gonna see some pain, but maybe that is one sector one can look at.
Interesting. On talking point today, viewers, we are speaking to a fund manager from Renaissance Investment Managers, who's been an IT analyst for 27 years, and he believes that this is the time to look at IT services. Well, do try and do your own research, of course, before you buy into thematic funds. Remember, that's the key thing, because these are high-risk funds, and past performance need not be an indicator of what will happen in 2024. Okay, Prableen, NFOs. We had planned to talk about NFOs with you. Any thoughts here? Because it's just a spate of NFOs out there.
Yeah, it's interesting. 2019, I was just calculating, we saw 145 NFOs. 2020, because of COVID, just about 52. And then 2021, it was 233 NFOs. Neeraj. So I think it came with a bang. 2022 about 143 NFO. So I'm talking about the filings. Some of the NFO filings don't get approvals or sort of postponed, and this year till now we've seen 69 of them. So very interesting combination, of course, because I think newer AMCs are coming, and every new AMC has to launch its own product. So you see a lot of the new AMC products there, and a rise in the passives as well. So, 5-8 funds just by Bandhan, they've only, IDFC earlier, IDFC, they've only, filed in the passive space. And this is equity. And a lot of passives in the, of course, debt space as well. That is something that we saw in 2022 and just before, till March of 2023 also, we saw a huge launch there. And we are still seeing, Motilal has actually filed for a ex-US ETF, so developed markets exposure without US. We are seeing Quant, it's coming up with the retirement fund. They filed for it, no approval as yet. So lots of NFOs, and then two themes again, Neeraj, here. One is the multi-asset. So out of the 13 funds that we have in the multi-asset space, actually 4 are less than a year old, and there are about 5 funds which are currently ongoing NFOs or in the pipeline. So I think multi-asset is seeing a lot of launches, and multi-cap as well. Also, I think understandably, because it's a newer category, a lot of fund houses had to sort of, they still have that slot empty in their overall basket.
Got it. And so probably what within this NFO universe, and I'm not just talking about ones that might be on right now, even the recent ones, which may have come out 6 months ago, what have you, what within this whole universe of funds looks interesting to you and why? You spoke about one of the thematic funds, but that notwithstanding, is there something that looks interesting, and if so, why?
So I think another segment which I missed talking about is the Nifty one-day rate index. That is something that we were not really seeing earlier. That is another segment from where we've seen about 5 to 6 NFOs, Neeraj, this year. And there was already one fund which was in 2022, which was renamed a Nippon fund. And this is basically for the trading accounts. So, when you trade, you get your money back in your demat account. So rather than moving that money out into your bank account, this ETF is being launched. Different fund houses have it, wherein you can just buy the ETF. It's like a one-day trade. So very low risk, very low credit risk and interest rate risk. And then you sell it, you get your money back. So rather than money sitting idle, it's like you can just park your margin money there. And this is for active traders, probably PMS providers, as well as those who are operating in, FNO. So that's an interesting segment again, which is a lot of launches there. Amongst the ones which I like, I feel that multi-asset, Neeraj, I think is a good space to be in, because currently I feel all the asset classes do look good, in the sense that fixed income, we are seeing that yields are still high. And with the inflation and with I think the global stance of the central banks, I don't see that the interest rates would be cut very soon, probably 2 quarters away at least. So definitely yields are fine there. Gold, I think, is always a good addition to your portfolio. And many of these multi-asset funds are also now having some allocation to silver or global equity as well. So I think it's a good space for those who are not sure, who don't want to take a pure equity exposure, want to keep it slightly more balanced. So this looks good, but within the multi-asset space, all different schemes have a different taxation. So, for example, a fund is being launched by Kotak, it has equity taxation, but the one which is being launched by DSP has debt taxation with indexation. So within that, the person has to check what is the structure and then look for the right suitable product for themselves. And I think even in the multi-cap space, I like that theme, a lot of funds being launched, but investors can actually look at something which is already there. Pre-launched funds which are already there, which have a little track record, not necessarily going for an NFO. And the quant retirement fund, that definitely looks interesting. I like to see that, because they say that they would move from equity to debt. So it's more like even gold, silver, and 35% foreign equity. So that would be a very different way to manage this fund, because most of the solution-oriented funds are typically aggressive hybrid or a flexi-cap approach. So this definitely looks different. So once probably it gets its approval, we'll get to know more.
Okay, thanks for that, Prableen. That's a very wide bucket of funds that people would look at. The for all you people who look at funds and also trade, maybe the ETF that Prableen spoke about could be an interesting addition to your fund portfolio if you don't have one. Now, Bharat, we not decided to speak this with you, but I'm throwing this out of the blue at you. Anything in the recent NFOs that looks interesting and why?
See I think she covered most of it, so I really don't have much funds left to talk about. I think one point where she mentioned, and it's a multi asset fund, right? Edelweiss recently came out with a multi asset fund, and it was a combination of an arbitrage and debt. So I think somebody who's looking to reduce the portfolio risk by and not having an equity exposure, I think post tax changes, I think it's a good fund. It doesn't have an equity exposure to it. It provides pure arbitrage. So around 55% of the portfolio will provide you an arbitrage return, and 45% of your portfolio will provide you that debt kind of a portfolio. So I think it's a good portfolio. It does provide you the benefit of debt taxation, which is 20% post indexation. So it's a good fund, non-equity in a market today when you're looking for a non-equity opportunities with a tax at your disposal in terms of a better taxation and not to have an equity exposure. I think it's a good fund. Don't have too many in this particular category as on today. I think that's a one fund which recently came out with an NFO, and I thought maybe a good differential product compared to the rest of the thing. See, everybody trying to fill their bucket of the products, as she mentioned. So those things keeps coming. We normally prefer idea which provides additional value to the client, and that's the whole thought process that every fund is evaluated in that particular context. I think this one fund has a merit in itself.
Great. Well, Prableen and Bharat, thank you so much for taking the time out and being with us today on the Mutual Fund Show. 3 very different topics, if you will. And thank you for giving your wisdom on all of those. Much appreciate your time.
Thank you. Thank you.
Pleasure. Thanks, Neeraj.